Hello guys, how are you? What's up? I hope you all are doing very amazing. People, today is going to be our last day of our CMA Final Law Marathon lectures. Today, our goal is to somehow get 10 marks by finishing off with 3 chapters. Number 1 is FEMA laws, number 2 is insurance laws, number 3 banking laws. These 3 chapters normally CMA Final students actually ignore. But people, trust me, if I tell you that in CMA Final Law syllabus, these 3 chapters are the most easiest one and the most practical ones. Would you believe it, guys? That's what we are going to understand today. Okay? So today our goal is to complete up with 3 chapters, FEMA, banking and insurance laws. Once we are done with these 3 chapters, guys, 100% of CMA Final Law syllabus will be done. Okay? Simply by watching my marathon lectures, solving my questions, case study based questions, there will not be even an iota of doubt that you will not get 70 plus marks. 100% if you have watched my every single lecture with determination, you have solved my every single question, you have read my mind maps, easily you can score 70 plus marks in CMA Final Law. Okay, shall we get started, guys? Let's quickly check if my voice is audible and the screen is clearly visible. Final Law. Okay, shall we get started, guys? Let's quickly check. All right. Hey Siri, 10 minutes timer. Chalo guys, we'll start with FEMA laws. So in the Google Drive, you will find 3 PDFs. FEMA laws, banking laws, insurance laws. So 3 PDFs, all the important topics of FEMA laws are included in the FEMA PDF. All the important topics of banking, you will find in the banking notes. All the important of insurance questions, you will find in the insurance PDF. Just by studying those questions, guys, you will be sorted. Okay? Please don't skip these 3 chapters. It's very important, very high scoring. If a question which is very difficult, if you are finding in Companies Act, guys, then this is the chapter that is going to revive you. Okay, guys? Chalo, shall we get started? Number 1 question, guys. First, let's see how many questions are there. 1. Oh. See, guys, how many questions are there? 16 question. Top 16 questions of FEMA laws. Study it, learn it, that's it. You will be sorted. Chalo guys, number 1 question is, state the restrictions on dealing in foreign exchange under section 3 of FEMA with examples. I have also included real life examples so you can connect the dots. I am also assuming that you have not studied FEMA laws, you have not studied banking laws, you have not studied insurance laws. With that situation in mind, I am going to teach you every single thing from the basic. Okay guys, section 3 of the FEMA restricts improper dealing. So basically, you are not allowed to deal in foreign exchange without the permission of RBI, without the permission of authorized dealer. This is what the question is trying to ask you. Okay. Number 1, dealing in foreign exchange without authorization. First, let's read the example. A sends $5,000 to B without using a bank or authorized dealer. It is not allowed, guys. So, a person shall not buy, sell, transfer, foreign exchange or foreign securities. He can do that, but through an authorized dealer, bank only. Number 1. Number 2, you cannot make payments outside India. You can make, provided you follow FEMA and RBI rules and regulations. An Indian resident sends 1 lakh rupees to cousin in Dubai without RBI permission. It is obviously a violation of FEMA laws. Okay. Number 3, payment is done, dealing is done. Now, receiving money from outside India also it is not allowed if you have not used authorized dealer bank. So every single time you are going to deal in foreign exchange, you have to make sure that you route it through a authorized dealer bank. Okay. Fourth, restriction on financial transactions for asset outside India. An Indian resident pays money to buy a land in UK without the permission of RBI, without routing through an authorized dealer bank. It is a clear violation. A person shall not enter into financial transactions in India with respect to purchase, creation, transfer of assets outside India. Such transactions are only allowed with RBI FEMA permission. So now guys, let's quickly revise. Number one, dealing in foreign exchange, making payments, receiving money, and restriction on financial transactions for assets outside India. Easy now guys. Are you able to understand the difference between all the 4 points? Very, very important question guys. This question will definitely come in your exam. You have to be well prepared. Okay. Chalo. Next question. State the restriction on holding of foreign exchange under section 4 of FEMA. We understood dealing in foreign exchange. Now, even holding of foreign exchange is restricted. Now, let's understand under what all scenarios you can hold foreign exchange reserves. Let's see. General rule says that no person resident in India shall own, shall hold, shall acquire, shall transfer the following. Now, what are those following? Foreign exchange, foreign securities, immovable property outside India. No person shall own, hold, acquire, transfer the following. What are the following? Foreign exchange, foreign securities, and immovable property outside India. But there are certain situations in which you can do all these things. Let's see guys. 1, 2, 3, 4. So in 4 scenarios you can hold foreign exchange. What are those 4 scenarios? Number 1, property held by a foreign citizen who becomes resident in India. Earlier I used to live in US, UK. Okay. I held a property in my name. Now I came to India. Now what should I do with that property? RBI will not tell that you are not allowed to hold that property because I was earlier resident in US, UK. Now I am a resident in India. So let's read this. A foreign citizen who becomes resident in India can continue to hold property outside India acquired before he became a resident. A US citizen shifts to India and already owns an apartment in New York. He can hold that property in New York. No problem in that. Okay. Number 2, property acquired before 8 July 1947, independence time, with RBI permission. So, example, a family in India owns a property in Kenya since 1945, but they have got RBI permission. It is completely fine. An Indian resident can hold foreign property acquired before 8 July 1947 if RBI permission is obtained. So you take the RBI permission, it is completely fine. Okay. Number 3, property received by gift or inheritance. I received a property from my grandfather who used to live in London. It is completely fine. A resident can hold foreign property received by gift or inheritance from person who legally owned it. My grandfather legally owned it in London. It is completely fine if I inherited that property after my grandfather's demise. Okay. 4th, property purchased through RFC account. Now over here you will get confused. Let's read the first example. A returning NRI, a returning non-resident Indian, uses money from his RFC account to buy a villa in Dubai. This is completely fine. If you are using your RFC money to buy a villa in Dubai or US, UK, it is completely fine provided you do the transaction using RFC account. A person can purchase a foreign property using funds from a resident foreign currency account. It is completely fine, no problem. So guys, 4 situations in which you can hold foreign exchange. Number 1 is, guys, tell me quickly, foreign citizen who becomes resident in India. Number 2, property acquired on or before 8 July 1947. Number 3, property received by gift or inheritance. And number 4, property purchased through RFC account. Completely fine, no problem. Guys, questions like this can come in your exam. You should not have any problem while writing it. Why? because language is simplified. I've also included real life examples, so you don't rote learn it. Okay, every single thing is given to you, intro is given to you, conclusion is given to you, you just have to learn it, that's it. Okay, chalo. Next question, explain current account transactions under section 5 of FEMA with schedule 1, 2 and 3. So FEMA says that you can deal in current account transactions, but there are certain current account transactions which are completely restricted. I will not say prohibited, it is restricted. Now let's understand those current account transactions. Section 5 says current account transactions are completely allowed unless they are restricted or prohibited. Now meaning of current account transactions, you know guys, day-to-day transactions are called as current account transactions. 1, 2, 3, 4. Example, import and export of goods and services. Importing laptops from Japan or exporting textiles to USA, it is called as current account transaction. Interest, royalty and dividend payments are called as current account transactions. Example, paying interest to foreign bank or receiving dividend from a foreign company, current account transaction. Foreign travel, foreign education, medical expenses, current account transactions. Remittance for family maintenance. My parents live in US, so I send money for maintenance of my parents, current account transactions. Now there are certain transactions which are restricted or some are prohibited. A person can freely undertake current account transactions unless they fall under schedule 1, schedule 2, schedule 3. Now let's understand schedule 1. Schedule 1 says remittance of lottery winnings. So guys, government does not want to promote gambling or betting. So any activity which is associated with betting or gambling, it is completely prohibited. So I have won money in betting, I have won money in gambling, I have won money in lottery. It is completely prohibited. One second guys, water time, water time. So remittance of lottery winnings, not allowed. I cannot send 5 lakh rupees lottery that I have won in India abroad, not allowed. Same income from gambling, betting, I cannot send it to abroad, not. Next is commission on export of certain goods. Example is tobacco. So I am running a tobacco company. I am paying money to a agent who lives in US. So he can increase the sale of tobacco. Not allowed. Why guys? Tobacco is against our health. So government wants to promote health. Government wants to promote safety. So government has restricted these, prohibited these transactions. Paying US agent commission for tobacco export, completely prohibited, not allowed. Next is purchase of lottery tickets, obviously not allowed. But guys, next is banned magazines. Sir, what is the meaning of banned magazines? Guys, there are magazines which spreads hatred, which spreads violence. So those magazines are banned by the government. So you cannot buy those magazines. Okay. So 4 type of transactions are completely prohibited. In your exam, if a question is asked, explain schedule 1 transactions under FEMA, you should be able to write that. Number 1 is guys, remittance of lottery. Now there are 3 more items which are associated with lottery. Number 1 is betting. Number 2 is gambling. Number 4 is buying lottery tickets. If we are buying lottery tickets, one more term is associated with lottery tickets, that is banned magazines. Okay. Next is, last is commission on export of certain goods. Example is tobacco, because government wants to promote health and safety. Okay. Next is guys, schedule 2 transactions. Now schedule 2 transactions are not completely prohibited, but they require approval of RBI. If you observe schedule 2 transaction guys, all these transactions requires a lot of heavy foreign exchange. If a lot of foreign exchange is used, in that case RBI's permission is required. Okay. Number 1 is guys, foreign exchange for cultural tours. If I want to send a dance troupe in foreign US, UK, I have to incur a lot of expenditure. So it requires RBI approval. Number 2, advertisement and print media by government or PSUs. So MLAs, MPs or government wants to advertise themselves in US, UK. So guys, money belongs to people of India, you have to take the permission of RBI. You cannot use that money to advertise yourself. And next is guys, freight payments for vessels chartered by PSU. PSU guys means public sector undertaking. Let's say Oil India Corporation. This company is owned by the government. So guys, tell me, can this company incur heavy expenditure in the ship vessels? They can, but they have to take the permission of RBI. Wherever vessels are involved guys, paying foreign shipping company, it requires a lot of foreign exchange, so you have to take the permission of RBI. Very easy guys. So 3 transactions require prior RBI approval. Number 1 is guys, foreign exchange for cultural tours abroad. Number 2 is advertisement in foreign print media by government or PSUs. And number 3 is guys, freight payments for vessels chartered by PSUs. Schedule 2 is done. Schedule 1 are completely prohibited. Schedule 2 is restricted. And Schedule 3 is completely allowed, provided you follow the limits. Schedule 3, allowed with limits. Number 1 is guys, private foreign travel. I'm going to Dubai, I'm going to US, UK. It is completely fine, provided I incur expenditure up to a limit. Next is education abroad, medical treatment abroad, donations or gift to foreign entities, sending money to foreign charity, completely allowed, but provided you follow the limit. The limit we are going to understand in LRS. Okay guys. So 4 type of transactions come under Schedule 3. Number 1 is foreign private travel. Number 2 is education abroad. Number 3 is medical treatment abroad. And number 4 is donation or a gift to foreign entities. Very easy. Okay. So current account transaction question is done. Next question. Explain the key provisions of foreign direct investment in India with examples. Again guys, very important. This question will definitely come in your exam. FDI means what guys? Investment. For example, if I tell you Apple has set up a factory in India, Tamil Nadu, Amazon or Tesla, if they set up a factory in India, it is called as foreign direct investment. Then sir, what is the difference between foreign direct investment and foreign portfolio investment? Foreign portfolio investment means what? When you invest less than 10% or 5%, we are going to understand the limit. There is a limit. If you invest less than a limit in the listed companies, it is called as foreign portfolio investment. But if it is apart from that, it will come under foreign direct investment. Now let's understand this in deeper level. FDI criteria. In unlisted companies, any amount of foreign investment is called as FDI. If it's unlisted company, I am investing into unlisted company, any amount will be called as FDI. A US investor invests 50 lakh rupees in a startup which is unlisted. This is FDI. Next is in listed companies, investment of 10% or more of paid up equity is called as FDI. If I am investing 12%, 13% in any listed company, it will be called as guys FDI. Now guys, there is a term called as fully diluted basis. Now what is the meaning of fully diluted basis? I spoke about here in paid up equity shares. Now what is the meaning of fully diluted basis guys? If a company issues convertible preference shares, company issues convertible bonds, convertible debentures, all these securities can be later converted into equity shares. So these are called as fully diluted basis. Wherever it is possible, equity shares can be issued. All those equity shares will be taken into consideration while we calculate the limit. Not just equity shares, convertible debentures, convertible bonds, convertible preference shares, all these securities which can be later convertible into equity shares, all possible type of equity shares will be taken into consideration while we calculate that limit. Okay. Next is, if the shareholding falls anywhere below 10% anytime, it will still be called as an FDI. It will still be called as an FDI guys. Okay. The shareholding later falls below 10% is still called as FDI. Okay. Now guys, next is sectoral caps. So how many points are there guys? 4 points are there. First we understood the meaning of FDI. Next, we're going to understand the sectoral cap. Guys, certain sectors are completely allowed, certain sectors are restricted or prohibited. Manufacturing sector is completely allowed. FDI is completely allowed over there. But defense sector, atomic energy, it is not freely allowed. In restricted sectors, government approval is required. So you can go through automatic route or you can go through government route, FDI. Okay. So entry route, guys, see automatic route, government route. Automatic route does not require the approval of government, but government route requires the approval of government. If I want to invest in media or defense, not me, but Elon Musk, Jeff Bezos, any foreign person, if they want to invest in media or defense, they have to take the permission of government because it is sensitive sectors, guys. But if they want to invest into IT sector company, it is completely fine. So IT sector will come under automatic route and defense sector will come under government route. Payment for capital instruments. Now first let's read the example. If a foreign investor subscribes to shares worth 1 crore rupees, 25 lakh shall be paid immediately and the remaining money can be paid within 12 months. So can we say, guys, 25% of the consideration must be paid immediately and the remaining consideration can be paid within 12 months. At least 25% must be made upfront at the time of issue. The balance amount must be paid within 12 months. So guys, these are the provisions of foreign direct investment. So if a question is asked, explain the provisions of foreign direct investment, you should be able to answer it. Okay. Can I get a thumbs up, guys, everyone? Chalo. Question number 5. Discuss the prohibited sectors for FDI in India along with exemptions. In which sectors FDI is completely prohibited? Okay. Prohibited sectors. How many prohibited sectors are there, guys? 9 prohibited sectors. Number 1 is, guys, lottery business. We know the purpose. Government does not want to promote lottery. If Donald Trump want to invest in lottery business in India, he cannot do that. Next is gambling, betting. Foreign investment is not allowed in online betting apps. Okay. Next is, guys, chit funds. So foreign investor cannot invest in local chit fund business because, guys, chit fund business is done by those people who don't know about finance that much. So if you are going to invest into chit funds, that means what? You are handing over such huge amount of money to those people who don't even have the financial knowledge, financial acumen. So do you think they are going to use that money properly? No. And that is why, guys, chit fund, foreign investment in chit fund is not allowed. Next is Nidhi companies. Same logic, guys. Nidhi companies formed to promote savings, to promote thrift. So immediately if you hand over to them 100 crores, 1000 crores, they will not be able to manage it. So guys, Nidhi companies, foreign investment is completely prohibited. Next is trading and transferable development rights. Guys, tell me one thing. If Donald Trump, Jeff Bezos, Elon Musk, who have got huge amount of money in crores, in billions, now if you allow them to purchase land in India, they will purchase land in India. But are they interested in developing India? No. Then, guys, why do you think they will develop the land in India? They will simply buy the land. They will wait for the land price to increase. And after that price increase, they will sell the land. But till that period, guys, land will remain vacant. Land will be of no use, guys. Is it in the interest of the nation? No. That is why, guys, trading in land rights are not allowed. Foreign investment in buying or selling development rights of land is completely prohibited. Real estate business, guys, same logic. Buying land only for resale or speculation is not allowed. Next is manufacturing of tobacco products. Obviously, guys, government wants to promote health, so they don't allow investment in cigarette manufacturing companies. Next is, guys, atomic energy, very sensitive sector. Not allowed. Okay. If we talk about railway operations, guys, In railway operations also it is a very sensitive area. If we allow foreign investment over there and for profit purpose, if they try to compromise the quality of railway lines, don't you think guys there is a risk involved? Hence, in railway operations it is completely prohibited. But if I want to give a infrastructure facility, I am not investing into railway lines, I am investing into seats, I am investing into toilets, it is completely fine. If you are trying to improve it, you are allowed. Okay guys. So 9 places foreign investment is completely prohibited. Number 1 is guys lottery business. Number 2 is gambling betting. Number 3 chit business, nidhi companies, trading and transferable development rights, then real estate business, then manufacturing of tobacco products, atomic energy, and last is railway operations. Very easy guys. Now specific restrictions. Investment from Pakistan or Bangladesh requires government approval. You know the reason. Certain sectors like defense and space have strict regulatory approvals. Defense manufacturing beyond limits will require government approval. Okay sir. Now exemptions. In which scenarios foreign investment is allowed? Under 4 situations. Number 1 is guys township development. Now what is the meaning of township development sir? Township development means what guys? You are investing into development of a mini city in India. Township means what? It's an area where hospital, schools, malls, roads, every single thing is there in a township. It is like a mini city. Hinjawadi phase 3, if I talk about megapolis, a society where I live in, it's a township. Every single thing is there nearby. So it's a planned city guys. So if foreign investment is there to develop a planned city, it is completely fine. The logic is guys, if foreign investment is made to earn money, to earn profit, for using it for unproductive purpose, it is completely prohibited. But if foreign investment is used to develop the economy of India, to help the Indian economy, it is completely fine. Are you able to understand guys? Behind every single law there is a logic. Foreign company investing in smart city projects to develop India, it is fine. Residential and commercial projects, construction of apartments and office buildings, fine. You are developing India. Infrastructure projects, roads, bridges, highways, you are developing India. Real estate investment trust, foreign investors investing into SEBI regulated real estate investment trust is also completely fine. So guys, how does mutual fund company works? Investors invest in mutual fund and that mutual fund will invest into shares. In the same way guys, instead of mutual funds, real estate investment trust will come where investors will buy securities in real estate investment trust, and this real estate investment trust will buy real estate. So if I want to buy a 200 crores worth of property, I will not be able to buy it. But if I buy real estate investment trust units, then along with 100-200 people, I will be able to buy that 200 crores worth of property. In return, I will receive interest. So 4 areas where foreign investment is allowed. Number 1 is township development. Number 2 is residential and commercial premises. Number 3, infrastructure projects. And number 4, real estate investment trust. That's it guys. Now let's understand the difference between foreign direct investment and foreign portfolio investment along with the example. Now guys, meaning of FDI. FDI simply means investment by a person resident outside India in unlisted Indian company. Any amount is fine. Even if I invest 1%, 2%, 3% in an unlisted company, it will be called as FDI. Or if I want to invest in a listed company, it should be more than 10%. A listed company with 10% or more shareholding, fully diluted basis, will be called as FDI. It indicates long-term investment with control or influence. So guys, FDI means 2 things. Number 1, unlisted Indian company I am investing in where there is no limit. And number 2, listed company I am investing 10% or more, it will be called as FDI. Okay. Now what is the meaning of FPI sir? FPI simply means shareholding less than 10% is called as FPI. FPI means investment by a foreign investor in listed Indian companies where shareholding is less than 10%, it will be called as FPI. If it is more than 10%, it will be called as FDI. Now, sir, if I have done FDI in a listed company, where I have bought in 12%, 13% shares, now that limit has reduced to 8%. Will it be then FPI? No, it will still be called as FDI. Are you able to understand, guys? A foreign investor buys 5% shares of TCS through stock exchange. This is FPI as it is below 10%. If FDI holding later falls below 10%, it will still be called as FDI. That's it, guys. So in exam, if a question is asked, explain the difference between FDI and FPI. Will you be able to write the answer, guys? Let me know in the chat box. Okay. Chalo. Next is explain the liberalized remittance scheme and the facilities available to resident individuals. Now, guys, everything with respect to LRS we are going to understand. LRS is, first of all, understand this one thing. LRS applies to only individuals like you and me, not to companies. Okay. So LRS allows resident individuals to send or remit foreign exchange up to US dollars 2,50,000 per financial year for permitted purposes. Provisions 1, 2, 3, 4, 5, 6, 7, 8, 9. 9 provisions. Number 1 is, guys, I am using that money for private visits abroad. It is completely fine. I am using that money for gift or donation. It is completely fine. Number 3, employment abroad for job search or relocation. It is completely fine. Next is immigration. I am using foreign exchange for visa, travel, initial stay. Fine. Maintenance of family abroad, business travel, medical treatment, studies abroad, other permitted transactions. So if I am using $2,50,000 for these purposes or any similar purposes, it is completely fine. Okay. Next is state the prohibited transactions under LRS scheme. What type of transactions are not allowed under LRS? Same logic, guys. If you observe FEMA, you will observe that very similar transactions are prohibited. See, purchase of lottery tickets or banned magazines, margin. So in FDI we understood for what purpose investors cannot invest in India. But in LRS we are going to understand for what purpose you cannot send money out of India. Number 1 is, guys, lottery tickets or banned magazines, not allowed. Margin trading in overseas exchanges. Over here you will definitely get confused. Don't rote learn it, guys. Simply understand. Let's say person A has invested 2,50,000 US dollars in a stockbroker, and the stockbroker is a US stockbroker. A person has invested 2,50,000 US dollars in a US. He has given money to US stockbroker. Okay, for trading purpose, obviously. Now, guys, his investment got reduced from 2,50,000 US dollars to 1,50,000 US dollars. Now, stockbroker is worried. What if your investment will fall? What if your investment will go in minus? Then we have to pay, right? So we require safety. So this stockbroker will ask the investor that please deposit margin amount. So we will not be worried about your investment going in negative. So if this guy deposits 1 lakh US dollars for the margin purpose, it is not allowed. Why, guys? The logic is simple. Wherever speculation activity is involved, it is not allowed. Trading is a speculative activity. You are not doing that many analysis. You are not going in research. Okay. So anything can happen in trading. Not it is necessary that every single time you are going to earn profit. No. Okay. So wherever trading, betting, gambling, banned magazines, lottery, is involved, guys, it is completely banned, completely not allowed. Next is, guys, purchase of foreign currency convertible bonds in secondary market. So you are not buying it from a primary market, you are buying this from somebody else. That is called as secondary market. Now what is the meaning of foreign currency convertible bonds? Bonds which are in foreign currency, which can be later converted into equity shares of a company. It is called as foreign currency convertible bonds. Bonds which are like loans, but it is not in Indian rupees, it is in foreign currency, which can be later converted into equity shares, is called as FCCBs. Now you are purchasing FCCBs from a secondary market, not from the primary market, not allowed. Why, guys? Because there is a possibility that you can route money indirectly. Okay, and such type of transaction can be entered into to hide the original source. We have learned prevention of money laundering in the last lecture. So FCCBs can also be used to do money laundering. So RBI says not allowed. Next is, guys, foreign exchange trading abroad. So you cannot deal in foreign exchange trading in abroad. Remittance for forex trading. Guys, you know forex trading, where you are buying and selling the foreign currency. It is not allowed, guys. It is completely prohibited. Okay. Now you might say that, sir, we have seen some people doing forex trading. They are using specific apps. That apps will use cryptocurrency or some other source of money, but not through a normal stockbroking channel. So it is prohibited. Okay, guys. Remittance to non-cooperative countries. You cannot send money to Pakistan. You cannot send money to Bangladesh. You cannot send money to North Korea. Okay, guys. Next is remittance to terrorism linked entities. Obviously, whichever company is engaged in terrorism, you cannot send money to them. So 6 types of transactions are completely prohibited. Purchase of lottery tickets or banned magazines, margin trading in overseas exchanges. Next, purchase of foreign currency convertible bonds from a secondary market. And next is foreign exchange trading abroad, remittance to non-cooperative countries, and remittance money to terrorism linked entities, not allowed under LRS. So guys, if in exam question is asked, state the prohibited transactions under LRS, you should be able to answer the question. Okay, chalo. Explain the requirements to be complied with by the remitter under LRS. So if you are using LRS, what all conditions you have to comply with, we are going to understand. Number 1, guys, you have to obviously deal or route your money through authorized dealer bank. We know this. Number 2, you should have a bank account, and that bank account should be active for at least 1 year. Bank account should be active for at least 1 year. Why, sir? Because, guys, immediately we'll open a bank account, immediately we'll send money abroad. It sounds fishy. Okay. Due diligence by bank shall ask the purpose, source of funds and transaction history before sending money abroad. Next is permitted currency. Remittance can be made in freely convertible currencies. US dollars, euros. Only permitted currencies are allowed. RBI approval for special activities. So over here, let's come. If bank wants to help customers to open deposit accounts in a foreign bank, they have to get the approval of RBI. Sir, what is the meaning of this? I did not understand. So bank wants to help customers open a foreign account in a foreign bank. Now guys, you tell me, if lakhs of customers open a foreign account in a foreign bank, from where are they going to send money to deposit that money? It will go out of India, right? India's foreign exchange reserves will get reduced. So government says you have to take the permission of RBI before you enter into such type of transactions. Bank simply wants to open customer accounts in a foreign bank. You have to take the permission of RBI. Why? Because a lot of money will be going out of India. Okay. Next is investment responsibility. So no fixed rating requirement. Risk is completely on the investor. If you are using LRS, you will bear the risk. Okay. So 6 type of provisions under LRS. Designate an AD bank. Number 2, bank account is required. Number 3, permitted currency. We know it is freely transferable, freely convertible currencies. 4th is due diligence by bank. Next is RBI approval for special activities, and next is investment responsibility will be completely on the person who is using LRS. Okay. Now guys, next topic is external commercial borrowing. This chapter, most of the students just skip it, but they don't know how beautiful, how practical this chapter is, guys. Okay, let's read this. External commercial borrowing are loans taken by Indian entities from non-resident lenders. If I want a loan, I am taking loan from a Japan bank. It is called as external commercial borrowing. Now you might think, sir, why do we take loans from Japan bank? Why can't we simply take loans from Indian bank? The reason is, guys, Japan bank will offer you loans at a very lower interest rate compared to Indian banks. So obviously I will take loan from Japan bank. This is called as external commercial borrowing. Now what are the provisions, guys? 1, 2. So 2 provisions are there. And the second provision, there are restrictions. 1, 2, 3. Okay? Chalo. 2 provisions, 3 restrictions we are going to understand. Number 1 is minimum average maturity period. So guys, RBI says that if you are taking a loan from a foreign entity, make sure that loan is for a long term period. If you use loan for a very short term period, you might use it for speculation trading activities. You can use it for short term purposes, which will in the end impact the foreign exchange reserves. Okay, if you are taking a loan from a foreign bank, make sure you are going to repay that loan after a long period of time. If I take short term loans, guys, I will fluctuate the foreign currency rates, which is not in the interest of the countries. Are you able to understand, guys? If continuously, simple, guys. You might all have, or you might all have heard 2 types of trades are there: intraday trading, positional trading. Now you tell me, in which type of trading there is a lot of fluctuations? Intraday trading. Why? Because people are buying today and they are selling within that day. But in positional, what happens is, I buy shares today, I might sell shares after 2 weeks, 3 weeks, 1 month. So in positional trade, there is less fluctuation if you observe. But in intraday, there is a lot of fluctuations. So RBI says we don't want fluctuations. So make sure the loan is for a long period of time. That is the reason why, guys, minimum average maturity period has been included. So ECB must have a minimum maturity period. This ensures that ECB is used for long-term funding and avoids short-term speculation. Example, ABC Limited takes a loan of $10 million from a foreign bank and agrees to repay it after 5 years. This satisfies the maturity requirement. Okay, guys, 1 second. Yes. Now, end use restrictions. Now that you have taken loan from a Japan bank, for what all purposes you cannot use this loan? For what all purposes you cannot use this loan? We are going to understand. Number 1, ECB can first understand prohibited uses. ECB cannot be used for capital market investment. You have taken loan from Japan bank and then you are using it for stock market investment. Not allowed. It is speculation, you know. Wherever there is speculation, gambling, betting, or tobacco, cigarettes, it is not allowed. Okay. ECB cannot be used for real estate speculation also. We know the logic. Okay. Buying land only for resale and profit is not allowed. Next is ECB cannot be used for equity investment. You are taking loan from a bank, foreign bank, and you are using that money to invest into shares in a company. It is not allowed. Okay, guys. If we allow that, guys, if we allow that, then suddenly there is a very high possibility that the ownership can easily get transferred to foreign individuals. So that is why government wants to have a very tight control of all the Indian entities, companies and land. So 3 prohibited uses. Number 1 is, guys, capital market investment, not allowed. Next is real estate speculation, is not allowed. Equity investment is not allowed. Now the question is, then where exactly it is allowed? ECB can be used for capital expenditure. If you are taking a foreign loan from a Japan bank and you are using it to set up a factory, it is fine. Okay. Next is, if you want to expand the business, for that purpose you are taking loan, it is fine. Third is permitted refinancing. Now this is very amazing. So I have taken ECB from a Japan bank in the year of 2026, where interest rate was 12%. Okay. Then after 2 years, in 2027, the tenure of loan is, guys, let's say tenure is 10 years. Okay. In 2027, interest rate has fallen to 6%. Now, guys, is it my fault that interest rate was high earlier? No. So what I will do is, I will again take a loan of, let's say, whatever amount is remaining to be repaid. I will take ECB again from a Japan bank, and I will use that to repay my old ECB. Don't you think now I have saved a lot of money? Earlier I was paying 10% interest rate. Now I have taken a loan again and I'm using that loan to repay my old loan. Why? Because right now the interest rate is less. I have to pay less money. Why should I pay more money? Because I took loan in a wrong time. Are you able to understand the logic, guys? So let's understand this. A company takes a new ECB to repay an old ECB at a lower interest cost. It is completely fine. Okay. Now, all-in cost ceiling. So RBI says that now you are taking ECB. Make sure that the cost of the loan is within the limit. You are not paying excessive money to the foreign entities who is giving you loan. There should be a limit. Beyond that limit, you cannot pay money as expense for the loan. I am not talking about the loan. I am talking about the expense for taking that loan. The total cost of borrowing, interest and fees must be within the RBI limit. If RBI allows a maximum cost of 8%, the company cannot borrow at 10%. Such borrowing would violate the cost ceiling rule. That's it, guys. So if an exam question is asked, explain the meaning of ECB and its key regulatory conditions with examples, you should be able to answer the question. Okay? Chalo. Next is discuss the prohibited end uses of external commercial borrowing with examples. Again, guys, we know where ECB money cannot be put, but we are going to understand in little detailed manner. Number 1 is, guys, real estate activities, we know. Capital market investment, we know. Equity investment also we know. Working capital and general corporate purposes, this is new. If you require ECB to pay salaries to your employees, to do small expenses, guys, don't you think you are not running a company in a proper manner? If you are running a company in a good manner, you won't require ECB to pay off your daily routine expenses. If you require funding to pay routine expenses, that means you are not running the company in a right manner. You are a financially distressed company. For that purpose, ECB is not allowed, guys. For that purpose, ECB is not allowed. But you are using that ECB to expand, to buy a factory, to set up a machinery, then it is completely fine. But for routine purposes, you are using ECB, not allowed. Okay? Chalo. Repayment of rupee loan. ECB cannot be used to repay domestic rupee loans. So you have taken you have taken a loan from SBI bank. Now you are taking ECB to repay the SBI bank loan. It is completely fine. So just now you told that you can use ECB to pay off old loans. That old loan was also ECB, guys. New one also was also ECB. Old one was also ECB. Both were ECB. But over here, I am using ECB to pay off rupee loans. Not allowed because they are not productive. Simple guys, what will I do is I will buy a loan from a bank and then I will take ECB to repay the bank loan. So don't you think I'm doing this continuously? Am I efficient? Am I doing anything productive? No. That is why it is not allowed. On lending to prohibited sectors, we know that where foreign investment is not allowed, so ECB cannot be used in prohibited sectors also. Atomic energy, defense, railway, not allowed. ECB funds cannot be lent to sectors where such activities are restricted. So, how many prohibited end uses? Real estate, capital, equity, working capital, general corporate purpose, repayment of rupee loan, on lending to prohibited sectors. That's it guys. Are you able to understand? Can I get a quick thumbs up? Everyone guys, everyone, can I get a quick thumbs up? Chalo. Question number 12. Explain the conversion of ECB into equity shares. So if you are converting ECB into equity shares, what all restrictions you have to follow, we are going to understand. What all rules you have to follow, we are going to understand. Number 1 guys, conversion into equity shares. ECB including any outstanding or unpaid amount can be converted into equity shares. Example, ABC has taken a $5 million from a foreign lender. Instead of repaying cash, the company issues shares worth $5 million to the lender. It is completely fine. Now, what are the conditions guys? Very, very important. In your exam, question can be asked. So, how many conditions are there? 1, 2, 3, 4, 5. 5 conditions are there. Reporting requirement is there. Very easy. So, what are the 5 conditions guys? Tell me quickly. Number 1, sector must permit FDI or approval required. So, if I am a defense company, I have taken ECB from a Japan bank, saying that after 1 year you can convert this ECB into equity shares. We know that foreign investment is restricted in media and defense. Now, do you think they will allow me to convert equity shares? No. Conversion is allowed only if the sector permits FDI or the government approval is obtained. In that case guys, sector permission is required. Let's understand this using example. A company in the manufacturing sector, 100% FDI is allowed, so you can give them convertible ECB. Convert ECB into share, this is allowed without approval. But if I talk about defense guys, then only by government approval only you can convert ECB into equity shares. Okay. Next is consent of lender is required before conversion, obviously. Next is no additional cost should be imposed. So if a person is taking loan from a foreign sources, Indian government wants to make sure the name of India is not going down. India should be respected. So for that purpose, Indian should not defraud the foreign people. For that purpose, this provision has been made. If I am promising this guy that after 1 year you can convert your ECB into equity shares, while he is converting, I cannot impose additional conditions on him. If I put additional conditions on him, that means what? I am ruining the image of India. Yes or no guys? In that case guys, it is not allowed. Every single thing should be said upfront before taking ECB. The company cannot charge extra fees during conversion. ABC Limited converts the loan into equity without charging any conversion charges or penalty. This is how ECB should be converted. Okay. Next is compliance with FDI pricing guidelines. Shares. Now that you are converting ECB into equity shares, shares must be given at a fair value. 100 rupees shares, you cannot give them just to 50 rupees. Okay. Next is compliance with sectoral caps. If a sector allows 74% FDI, you have to comply with that limit while you are converting into equity shares. Okay. So guys, 5 conditions. Number 1 is sector must permit FDI first of all. Number 2, consent of lender is required. Number 2, no additional cost should be imposed. Number 4, compliance with FDI pricing guidelines. Number 5 is compliance with sectoral caps. That's it, guys. Now let's talk about reporting requirement. So ECB can be converted into 2 ways. Either it can be partially converted or it can be fully converted. If ECB is partially converted, FCGPR form and ECB2 return must be filed. If it is full conversion, again FCGPR form and ECB2 return must be filed. Sir, what is the difference between 2 forms? Over here, if you are converting 6 months, after 6 months you are again converting the remaining amount, then you have to file 2 times ECB2 and FCGPR. But over here, if conversion happening only 1 time, then only 1 time you have to file FCGPR and ECB2. Okay, so this is how, guys, ECBs are converted into equity shares. Okay, next is explain the ECB limits and debt equity ratio. Very, very important topic, guys. I am 100% sure this question will come in your exam. 100% sure. Okay. Until now, guys, there has not been a single question on ECB. But because there is no single question on ECB, definitely this question will come in your exam. You take my word. Chalo. ECBs are subject to limits to control excessive foreign borrowing to ensure financial stability. If everyone excessively takes ECB loans and they fail to repay, guys, it will completely collapse the economy of India. That is why certain restrictions have been made. 1, 2, 3. 3 restrictions, guys. Number 1 is ECB limit. So maximum ECB allowed under the automatic route is $750 million per financial year. Example, if ABC wants to borrow US dollars $900 million, are they allowed, guys? Yes. 750 they can get under automatic route, and the remaining money they have to route it towards government approval. This is the crux. Okay, guys, $750 million every year you can do it from automatic route, but remaining money, anything above that, you have to take the permission of RBI. Next is debt equity ratio. The ratio between ECB and the equity must not exceed 7:1. Sir, I did not understand anything. XYZ Limited has equity shares worth 10 crore rupees. So maximum how much ECB they can get? 70 crores. The company borrows 80 crores, it will violate the ratio. So 7:1, the ratio must be maintained so that company does not take excessive ECB loans. This means for every 1 rupee of equity, the company can borrow a maximum of 7 rupees through ECB. Exception to 7:1. So when will this 7:1 rule will not be applicable? If the company is taking ECB for a very small amount, in that case, guys, this rule will not be applicable. Now, how much small amount? The 7:1 ratio is not applicable if ECB is up to $5 million. Are you able to understand, guys? If a small company borrows US dollars $3 million from abroad, even if the equity ECB ratio is less or more, still they can borrow, provided maximum amount will be US dollars $5 million. So guys, tell me quickly 3 restrictions. Number 1 is ECB limit will be $750 million per financial year. Number 2, 7:1 debt equity ratio you have to follow. And number 3, exception is up to $5 million. It is completely fine even if you don't follow the debt equity ratio. Okay, question number 14. Explain the concept of trade credit and types under its FEMA. So what is the meaning of trade credit? We are going to understand. Simple, guys. It's a system where goods are imported now and payment is made later as per the agreed terms. Is called as trade credit. I have imported goods right now, but after 6 months I will pay you money. This is called as trade credit. That means supplier has given me some time. It is called as trade credit. Now there are two types of trade credit, but let's understand the meaning. Is provided by foreign suppliers or foreign banks. Okay, an Indian company imports machinery from Germany and agrees to pay after 6 months. This is called as trade credit. Now what are the types of trade credit? Two types of trade credit. The supplier allows deferred payment to importer. So supplier is given time. Supplier is giving time of 6 months. That after 6 months you can pay me in a lenient manner. It is completely fine. An Indian importer buys goods from a Chinese supplier. An Indian importer buys goods from a Chinese supplier. The supplier allows payment after 90 days. This is called as supplier's credit. Now let's talk about buyer's credit. What is the meaning of buyer's credit? An Indian company imports machinery from Japan. An Indian company imports machinery from Japan. A foreign bank pays a Japanese supplier immediately. So foreign bank will pay the supplier. Has the buyer paid the supplier? No. Foreign bank has paid to the supplier. The Indian company repays the bank after 1 year. This is called as buyer's credit. A foreign bank or a financial institution pays the supplier on behalf of the importer, and then the importer later repays the bank. Very easy, guys. Two types of trade credit. Supplier's credit and number 2 is buyer's credit. Are you able to understand, guys? Can I get a quick thumbs up, everyone? Okay. Next is, guys, maturity period. We know short term trade credit is up to 1 year, mainly for non-capital goods, for raw materials, where payment will be made after 6 months. It is called as maturity period. That is called as short term credit. But one more type of credit is there, that is medium term credit. That is payment up to 5 years is completely fine. This happens in capital goods. Example, import of heavy machinery with payment due after 3 years is called as capital credit. Now guys, tell me quickly, number 1, we know the meaning of TC. Now types of TC, supplier's credit, and number 2 is buyer's credit. Maturity period, we know, guys, two types of maturity period, short term TC and number 2 is medium term TC. Next question, explain the procedure for raising an ECB. Simple, guys, we know the meaning of automatic route, we know the meaning of approval route. In automatic route, you will not require the permission of RBI. Example is manufacturing sector, but in approval route, you have to take the permission of RBI. Guys, once again, hey Siri, 10 minutes timer.
10 minutes starting now.
Chalo guys, ECB can be raised without RBI permission, is called as automatic route. This is allowed only if all the conditions of ECB are satisfied. ABC Limited, a manufacturing company, borrows $100 million from a foreign bank for purchasing a machinery. Since it satisfies all ECB conditions, it can raise funds under the automatic route. Okay. Next is approval route. RBI approval is required if ECB conditions are not fulfilled. The borrowing falls under restricted categories. Now, sir, can you give me an example? Let's read this, guys. XYZ Limited wants to borrow funds for a purpose not permitted under ECB guidelines. So you are taking ECB for a purpose that is not under the ECB guidelines. It must obtain the approval of RBI. Simple, guys. That's it. Automatic route, approval route. Now, what are the compliance requirements? ECB limits you have to comply. We know $750 million per year. Number 2, we know the end restrictions also. Number 3, we also know they have to meet minimum maturity requirements. That's it, guys. Next is explain the parking of ECB proceeds and securities for ECB. So you have obtained ECB. You have taken an ECB. Now immediately you don't plan to start your business. You will plan to start your business after 1 year or 2 years or 6 months. Now, the important question is, what are you going to do with that ECB until that period is what we are going to understand. ECB proceeds must be handled and utilized very carefully and security must be provided to lenders as per RBI guidelines. Now provisions 1, 2, 3. 3 provisions. Parking of ECB proceeds. ECB proceeds can be parked abroad from foreign currency expenses in safe liquid investments. Now guys, let's read the example. ABC borrows. Simple guys. If I have taken ECB in US dollars, I have taken ECB in US dollars. Now I'm not intending to use that ECB immediately, but after 1 year I also plan to import machinery from US. For importing I have to pay money in US dollars. So why will I bring that ECB into India? Why will I convert dollars into rupee when I know that I have to make payment in US dollars? So what I will do is I will park my money in US only. Okay, now let's read this. Parking of ECB proceeds. ECB proceeds can be parked abroad for foreign currency expenses. I'm importing machinery in safe liquid investment. There's a concept called as safe liquid investment. You cannot use it for stock market purpose. Investment shall be safe. Okay. ABC Limited borrows $5 million and keep it in a foreign bank deposit, which is a very safe until it is used for importing machinery. Very easy guys. Next is, now I have taken ECB but I have my expenses in Indian rupees. I have taken ECB but my expenses are in Indian rupees. In that case guys, I have to bring that money and deposit them in AD bank account in India. Simple. Credit to a rupee account, maintain it with a AD bank. Next is, now that you are depositing that ECB in a bank. So guys, don't you think if you deposit ECB money in bank, you will also earn interest? So what people can do is, people can borrow ECB and they can deposit in a bank. So simply they are earning interest. So RBI says this is not allowed. You have to use that money within 12 months. Temporary parking is allowed in term deposits up to 12 months. A company keeps unused ECB funds in a fixed deposit for 6 months before using them for business expansion. Up to 6 months you can store it in India. Within 12 months you have to use it. Okay, within 12 months you have to use it. So 3 things we have understood guys. Number 1 is parking of ECB proceeds. If it is abroad, we know we have to park it in safe liquid investment. Number 2, ECB proceeds can be brought into India if my expenses are in Indian rupees. Number 3 is temporary parking is allowed if I plan to use that ECB within 12 months. Now security for ECB. Now that I have taken ECB, I have to give something as a security. Security may be provided with the approval of AD category 1 bank. A company takes approval from its bank before offering assets as security for ECB. Now securities can include guys, immovable property, factory, land, building, movable assets, machinery, equipment, shares or bonds, personal or corporate guarantees. Promoter gives personal guarantee or the parent company gives a corporate guarantee. These are allowed. Now to protect that security, I have to appoint a security trustee. A trustee is appointed to hold and manage security on behalf of the foreign lender. That's it guys. So we are done with the FEMA laws. All the important topics of FEMA laws are done in just 1 hour 9 minutes. Okay guys, so we'll take a break of 10 minutes. 10 minutes break and we'll meet at 5:49 PM. Chalo guys. Hello. Yes. So people, we are done with 95 marks. Now, insurance laws and banking laws. These two chapters are remaining. The lengthier chapter is, guys, banking laws. Okay, beautiful chapter, guys. Very easy chapter. Insurance and banking, very easy chapter. Let's find out how many questions are there. Thank you, भाई. हाँ, मैं करता हूँ. तो जी पे देखो, स्कैनर. Yes. So how many important questions are there, guys, in banking laws? Question number 1. We'll directly go till the end. So guys, 9 questions are there. If you study these 9 questions thoroughly, you will be sorted. Okay? Chalo. Number 1 question. What are the restrictions on loans and advances by banks under Banking Regulation Act 1949? So what are the restrictions on bank with respect to loans and advances? We are going to understand. Number 1, guys, how many provisions are there? 1, 2, 3, 4. 4 provisions. Number 1 is, guys, loans to director. If you are a director of HDFC Bank, you cannot take a loan from HDFC Bank. Why? If you take a loan from HDFC Bank and you are the director of HDFC Bank, don't you think you will make changes in the company only to favor you? So this is not allowed. Sir, but if bank's job is to give loans, I am a director, so why will I be stopped from getting a loan? Then from where will I get a loan? You will get a loan from other bank, but not the bank in which you are a director. Always understand this, guys. If you are in position of a director, you will make changes, you will take decisions that will in the end favor you as a borrower. So not allowed. A banking company shall not grant any loan or advance to any of its directors, any firm in which a director is interested, or any individual for whom a director is a guarantor. Any association, if you are a director, that person will never get a loan. If a director of a bank is a partner in a firm, the bank cannot give loans to that firm. Very easy, guys. Logical law. Next is prohibition on security of own shares. So I want, let's say, I own 5% of shares in HDFC Bank. Okay. Now, while I take a loan, I also keep shares of the HDFC Bank as a security. So loan I have taken from HDFC Bank. Now I have to give something as a security. So I give HDFC Bank shares as a security. Not allowed, guys. Not allowed. So if I make a default, that means, does that mean the HDFC Bank will sell their shares? No. So in both the situations, they are loss. So law says that security can be of any other bank but not HDFC Bank. A bank shall not grant loans or advances against the security of its own shares. Okay. Next is RBI control in public interest. So RBI has the power to control the loans, advances in the interest of the public. They can make any changes. Now powers of RBI. RBI can issue directions to the bank saying that for X, Y, Z purpose you cannot give loan. Only for these purposes you can give loan. Number 2, margin requirements. RBI may prescribe the margin to be maintained in a secured loan. If you being a bank, if you are giving a loan, you have to keep X, Y, Z percentage of the loan as a security. RBI can tell you. Rate of interest. RBI may regulate the rate of interest. We know this. Maximum limit on loans. So RBI may fix limits on the maximum amount of loan to a single borrower, so that banks cannot put all the risk in any one person. So guys, you all must have heard this phrase called as never put all your eggs in one basket. So you have to diversify your risk. If all the loans are only given to one borrower, there's a risk involved. If this borrower defaults, you are gone then. Are you able to understand, guys? So number one is loans to relatives, section 20, prohibition on security of own shares. RBI can control in public interest. And number 4 is powers of RBI, purpose of loan, margin requirements, rate of interest, maximum limit on loans. Okay, sir. Next is state the provisions of the Banking Regulation Act 1949 with respect to disposal of non-banking assets. Beautiful topic, guys. Beautiful topic. Simple. If I have given land as a security for a loan, in that case, how shall the bank deal with that land that I have given as security? So, Section 9 of Banking Regulation Act 1949 deals with the disposal of non-banking assets held by a banking company. Okay, provisions 1, 2, 3, 4. 4 provisions, very simple, let's understand. Restriction on holding immovable property. If a bank acquires land due to loan default, it must sell within 7 years, guys. It shall not hold land for more than 7 years. A banking company shall not hold any immovable property for more than 7 years. Okay. Next is disposal within prescribed period. Such property must be disposed of within how many years? Within 7 years from acquisition or from commencement of the act, whichever is later. You have to dispose of the land within 7 years. If bank is keeping that land, bank has to manage that land also. But bank's job, is it to manage money or manage land? It is to manage money. So bank cannot do different activities at the same time. So bank will then become a real estate company, not a banking company. For that purpose, guys, this provision has been made that says bank shall dispose of the land within 7 years. Okay. Third is temporary dealing for disposal. During this period, guys, a bank may deal or trade in such property only to facilitate its sale. They can improve the land so they can get a very good value. The bank may lease or maintain the property to make it more saleable. Extension by RBI. RBI may grant extensions period up to 5 additional years. Apart from 7 years, you can get up to 5 additional years benefit. Such extension is granted only if it is in the interest of depositors. Because guys, tell me one thing, the money in the end belongs to whom? Depositors. Using the money of depositors, bank is giving loan. Now that person has defaulted in the loan. Now we have got the land, we are not getting the loan in any way. So with the land, how are you supposed to use the land? So we do justice to the depositor. Are you able to understand, guys? Money belongs to the depositors. Now the moment this guy defaults in the loan, now we are not getting the loan anyway. We have the land now. Now we have to use the land in such a way that we do justice to the money of the depositors. Are you able to understand, guys? So 4 things we have understood. Restriction on holding of immovable property, disposal within 7 years. Third is temporary dealing for disposal, and fourth is extension of 5 years can be granted by RBI. Okay. Next is question number 3. Analyze the role of RBI in the formulation of monetary, banking and financial policies in India. So what exactly RBI does in terms of formulation of monetary, banking and financial policies? Let's understand them. Number 1, guys, bank inspection and regulation. RBI conducts regular inspection under Banking Regulation Act 1949. It ensures stability, compliance and protection of depositors. Because of RBI, no bank today can defraud the depositors. Okay. Next is, guys, policy formulation and prudential norms. Very important. Don't skip it, guys. It might look boring, but it is not boring. It is very interesting. RBI issues guidelines on income recognition, asset classification, provisioning, capital adequacy. It follows global standards like Basel norms. Don't feel bored when you read this. Let's understand now the meaning. When you understand the meaning, guys, you will find it very interesting. What is income recognition trying to tell you? Interest will be called as an income when you receive it or when you not receive it. When you receive it, obviously. So if a bank classifies interest that has not been received by them immediately, but they classify them as income, don't you think, guys, they are not following the accounting standards? Simple. You tell me, interest received, not received. If they receive interest, then only they will classify it as income. If they don't receive interest, why will they classify this as income? But if they classify this as income, what will happen? Books will show that bank has got huge amount of money. It will mislead the investors, government and depositors. So government will tell which income can you recognize in your books of accounts, which income you cannot recognize in your books of accounts. Okay. Number 2 is, guys, asset classification. So if loan has not been repaid within 90 days after a period, it will be classified as NPA. So bank will say that when can you classify the loan as a safe loan, when can you classify a loan as a non-performing asset. You must all have learned this concept called as NPA, guys. RBI will inform you when can you call a loan as a NPA, when can you call a loan as a safe loan. Okay. Third is provisioning. So RBI says every bank has got bad loans. Not every time bank will get 100% amount of money back. So many times there's a huge possibility that bad loans can arrive. So RBI says that you have to be prepared for the bad loans. You should not be over optimistic that no, all my borrowers will repay me money. No, a few borrowers will definitely default in the loan, but you have to be prepared for it. That is what RBI tells about provisioning. Set aside money so that you are prepared for the bad debts. Okay. Next is capital adequacy. That means what, guys? Public deposits more capital. What is the meaning of this? If public deposits are more in your bank, guys, then don't you think you have to try your level best to protect the money of the public? You have to be extra careful. In that case, guys, RBI says the bank that you have to put in more of your capital in this bank so that public's money will be safe. People, do you remember when we studied SEBI regulations and the promoter's contribution? If you are using money towards capital projects, promoter's lock-in period will be 3 years. But if you are not using the money for capital projects, promoter's contribution will be 18 months. Why? Because regulators say that if there is a risk involved, you have to stay in the risk. You cannot use public's money. You cannot use public's money in the risk. You should also use your money in the risk. This is what all the regulators tell. You have to put your investment also into the basket. You cannot simply use other people's money into the basket. That is a core logic. Next is, it follows global standards like Basel norms. Okay. So formulation and prudential norms, RBI issues guidelines on income recognition, asset classification, provisioning, capital adequacy. It makes sure that it follows global standards like Basel norms. Okay. Next is licensing and branch expansion. A bank must take obviously RBI's approval before starting a bank. If they want to open a new branch, again RBI's approval is required. Okay. Now fourth, board level appointments. This is very, very interesting. RBI approves appointment removal of top management in private banks. It recommends appointments in public sector banks. Appointment of CEO in a private bank requires RBI approval, guys, because banks are the most sensitive sector in India. So RBI will make sure that it is supervising every single aspect. Okay. Chalo, guys. Next is anti-money laundering. We have studied this yesterday. RBI monitors compliance with Prevention of Money Laundering Act. It ensures banks follow KYC norms properly. They must verify customer identity to prevent illegal transactions. Next is managing overseas operation. If an Indian bank has got overseas branches, RBI will also supervise all of them. RBI regulates foreign operations of Indian banks. It approves foreign branches and joint ventures. An Indian bank requires RBI approval to open a branch in Dubai. Okay. Next is precious metals and foreign exchange management. Beautiful topic. Now guys, simple. In your CMA Inter Data Analytics, you must all have learned that if the rupee value reduces, RBI will sell dollars so that rupee value will increase. You all have heard this, right? In news or in data analytics also, you must all have seen this. The same way guys, RBI manages foreign exchange reserves. They also deal in gold and other precious metals. Now, out of syllabus I am talking, you will have one question. Sir, how will increase in the supply of US dollars, how will selling US dollars will increase the value of rupees? There is no connection in that. Let's understand this. 4 steps are involved guys, simple. The moment RBI realizes that rupee value is getting reduced, that means what? Rupee supply is increasing, that is why rupee's value has fallen. So now we need to reduce the supply of rupee. So RBI will sell US dollars, so they will increase the dollar supply. Now if they increase the dollar supply, what will happen? People will buy US dollars, but by giving what? But by giving rupees. If I have got Indian rupees, I want to buy US dollars. So I will buy US dollars by selling my Indian rupees. The moment I sell my Indian rupees, this money will go to RBI. Rupee will go to RBI. Then rupee supply will reduce because money is going to RBI. Now, if rupee is less in the market, don't you think value of rupees will increase? So this is how guys, by selling US dollars, rupee value will increase. Just out of syllabus, but you should know all this. Okay guys? Chalo. Conclusion is RBI plays a very important role in maintaining financial stability, regulating banks, implementing monetary policy and safeguarding public interest. So if a question is asked guys, analyze the role of RBI in the formulation of monetary, banking and financial policies in India, you should be able to write all these points thoroughly. I explained you every single thing using examples, so you should not have any problem. Okay guys, chalo. Now that we come across a term called as Basel framework. Now exactly what is the Basel III framework we are going to understand. Chalo guys, Basel III is an international banking framework developed to ensure that banks remain financially strong, stable and capable of handling risk and economic shocks. So these are rules, global rules that is supposed to be followed by all the banks so they can be prepared for the worst case scenario and they can be stable. Pillar 1, Pillar 2, Pillar 3. Fourth is capital requirement. Okay. Now what does Pillar 1 says? Minimum capital requirement. So banks must maintain minimum capital based on the level of risk in their assets. If risk is more, you have to include more capital. Same like promoters' contribution in SEBI. If a bank gives a loan to a startup, it must keep high capital. If a bank gives loans to government, risk is less, so you can keep low capital. Next is Pillar 2, supervisory review. RBI monitors banks and reviews their risk management. Are they following all the rules and regulations that has been given by us or not? RBI can require banks to maintain additional capital if they feel that risk is very, very high. Okay. If RBI finds that a bank is giving too many risky loans, it may direct the bank that you now have to increase the capital base. Are you able to understand the logic, guys? Every single rule, there is a logic. Okay. Third is market discipline. Banks must disclose Next is, guys, banks must disclose financial information to the public. This ensures transparency and helps investors assess the bank's health. So if bank does not disclose financial information, how will RBI know that if this bank is performing well or not, if these banks are giving risky loans or safe loans? So every single bank shall send financial information. Next is, guys, capital requirement. This is very, very important. Banks in India must maintain a minimum capital adequacy ratio of around 9% of risk-weighted assets. Sir, what is the meaning of this? If a bank has got 1000 crores of risky assets, they must maintain at least 90 crores as capital. Okay. So Basel III ensures that banks maintain sufficient capital. So guys, tell me quickly, Basel III framework. Pillar 1 talks about minimum capital requirement. Pillar 2 talks about supervisory review. Pillar 3 talks about market discipline. And Pillar 4 talks about capital requirement. Very easy. Jayanand, are you able to understand every single thing? Can I get a quick thumbs up? Okay. Next, guys. Explain the restrictions on banking business under section 19, 20 and 21. Non-banking business restrictions, prohibited loans, which we know, RBI will control advances. We know this, guys. So banks cannot control non-banking companies. If you are HDFC Bank, you cannot control any other company that is not a banking company. A bank cannot own a cement manufacturing company as it is not a banking business. Next is, we know banks cannot give loans to directors, their firms and against their own shares. We know this. RBI control over advances. So RBI will control the lending policies. Simple, guys. Introduction, provisions and conclusion you have to write and then you are sorted. This is how you have to present your answers in the exams. Okay? Perfect. Chalo. Now, next topic. Explain the role of RBI in formulation of banking policy and procedural norms. Again, guys, repeated topics, but still we are going to understand this. Capital adequacy, income recognition, investment valuation, credit exposure limit, risk management and conclusion. So 5 topics. Number 1, guys, banks are required to maintain minimum capital. We know 9% as per Basel norms. Income recognition, non-performing asset. A loan is called as NPA if it is overdue for more than 90 days. We know this. Banks must make provision for bad loans. We also know this. Investment valuation. Bank investments are required to be marked to market. What is the meaning of this, sir? Investment value, if it is changed, you should immediately change it in the books of accounts. So your books of accounts shows true and fair view of the position of the company. This ensures that investments are shown at their current market value. If the value of government bonds falls in the market, banks must immediately reflect the reduced value in its books. Okay, talking about credit exposure limit. RBI of India limits lending to a single borrower or group of borrowers. This reduces risk concentration. I told you guys, never keep all your eggs in one basket. Same logic. A bank cannot give excessive loans to one large company as it may increase the chance if that company fails. Increase the risk if the company fails. Next is risk management and asset liability management. RBI of India issues guidelines on asset liability management. It ensures banks can meet both short-term and long-term obligations. If a bank gives long-term home loans, it must ensure it has got sufficient long-term funds to support them. Simple, guys. If you are giving loans, you must have adequate capital. This is what the pointer is trying to tell you. So 5 points. Number 1 is capital adequacy. Number 2 is income recognition. Number 3 is investment valuation. Number 4, credit exposure limit. Number 5, risk management and asset liability management. And we are done. Question number 7. Now guys, this is the most important topic. Very, very important. Definitely in an exam, question can be asked. Explain the procedure of enforcement of security interest under section 13 of SARPC Act 2002. Section 13 empowers secured creditors to recover NPA without court intervention. Simple, guys. I am a secured creditor. You are a bank. You have given me a loan. I have given you a security. I did not repay you loan on time. Now, what will you do with that security? Do you have enough knowledge to sell the asset to the right person at the right time? No. So, what you as a bank will do is, let's come over here. So, banks, first of all, listen to me very, very carefully, okay? Banks have given loan to this guy, this guy, this guy, this guy, this guy. Let's say to 5 borrowers bank has given loan to. He repaid loan. This guy repaid loan. Okay. So who did not repay the loan? Blue. So what is the total amount of non-repaid loan, guys? Tell me. 1 crore, 2 crores, 3 crores. So 6 crores loan is an NPA. It's an NPA for a bank. Now bank, what will bank do, guys? Will bank now go and sell the security, find the buyers? No, they don't have that much time. They don't have the expertise. So what bank will do is, bank will give all these loans. Bank will sell all these loans to an asset reconstruction company. Banks will give all these loans to asset reconstruction company. Now, what is the job of asset reconstruction company? We are going to understand. 6 crores banks have got NPA, non-performing asset. Now, bank will sell this NPA to asset reconstruction company. So, ARC will pay bank immediately 40 crores. So, instead of 6 crores, bank suffered a loss of 2 crores because ARC have paid the bank 4 crores. They have purchased bad loans from the bank at 4 crores. Till here, guys, no confusion. Borrowers defaulted for 6 crores with the bank. Bank requires money. Bank will go to ARC. Bank will sell these bad loans to ARC. ARC will pay bank 4 crores. 2 crores, bank is okay with the loss. Instead of 6 crores, 2 crores loss is completely fine. Now, from where will ARC get money to pay 4 crores, guys? So, anyone who are interested in earning money through security interest, what they will do is, they will invest 5.7 crores. Let's say they have invested 5.7 crores with the ARC. ARC will give them security receipts. It's like shares. SR is like shares. So investors have given 5.7 crores to ARC. ARC in return have given them how much? Security receipts. Okay, they have not paid any money to investors till now. They have only given them security receipts. Now using this money, guys, 5.7 crores, ARC will pay bank how much? 4 crores. Bank is happy. ARC is happy. Now how will investors be happy? Did investors receive anything? No. Now how will investors get their money back? So what ARC will do over here is, ARC will approach the defaulted borrowers. ARC will approach the defaulted borrowers. They will recover money from the borrowers. Let's say they were able to successfully recover 5.75 crores from the borrowers. ARC was successfully able to recover 5.75 crores from the borrower. So now with that money, they will give it to investors back. They will repay the investors back. So how much money investors gave in? 5.7 crores. But how much money investors got in return? 5.75 crores. 50,000 rupees. Was there profit, guys? Yes or no? Not 50,000, it will be 5 lakh. It will be 5 lakh. Now, guys, tell me, bank is happy. So instead of 6 crore loan, 6 crores, instead of 6 crores loss, they are only suffering 2 crores loss. Bank is happy. ARC is happy. Why? Because they were able to recover 5.75 crores from the borrowers and they paid 5.7 crores to the investors. So investors are happy because they got money, extra money. Now guys, let's say ARC got 5.75 crores and they repaid to these people 5.73 crores. 5.73 crores. The remaining money will be a profit for ARC. So borrower is happy. Sorry, borrower, why will borrower be happy? Investors are happy, bank is happy, ARC is happy. Jayanand, are you able to understand this arrangement? Simple guys. Again I will tell you. Borrowers defaulted for 6 crores with the bank. Now bank wants to recover money back. So bank will approach to ARC. Bank will approach ARC. ARC will immediately pay 4 crores to the bank. Bank is happy. Instead of 6 crores, they are suffering 2 crores loss. Bank is happy. Now, how will ARC receive money? Investors have poured in 5.7 crores to the ARC. ARC in return will give them security receipts, or we can say just represent them as shares. Now, ARC will recover money from the borrowers. Let's say they were able to recover 5.75 crores from the borrower. So now ARC has got 5.75 crores money. Now they will repay to the investors 5.73 crores. Investors, when they invested, they paid 5.7 crores. When the money they received back was 5.73 crores. Investors are happy, bank is happy, and the remaining money will belong to ARC. This is how asset reconstruction company actually works. Okay, chalo. Now let's read this. And ARC is a company registered with RBI that acquires non-performing assets from banks. Means what? Non-performing loans, bad loans, and recovers them through a structuring or sale. 1, 2, 3, 4, 5, 6, 7. 7 points, guys. Let's read this. Number 1, acquisition. First, they will acquire bad loans from the bank. We know they will purchase bad loans from the bank. They will issue SR to the investors. Now, the companies that did not repay the banks on time, now ARC will take over. ARC will take over the management of borrower companies so that they can recover their money. So now they have got 3 options. They can restructure the loans. So instead of 10 years loan, they will extend the timeline as 12 years loan. This is one possible scenario. Next is selling assets. Number 2. Number 3 is changing the management. 3 options they have got. Okay. Management of borrowers money, borrowers business. ARC can take over the management of defaulting companies. Acting as the agent or manager. ARC may act as a recovery agent or manager of secured asset. Registration requirement. ARC must be registered with the RBI. They must verify financial and governance conditions. Okay. This will be regulated by RBI. That's it, guys. So 6 points. Number 1 is acquisition of NPA. Number 2, issue of SR. Number 3, asset reconstruction recovery. 3 ways: by restructuring loans, by selling assets, by changing the management. Management of borrowers business, acting as agent or manager, registration requirement with the RBI, and last is regulation by RBI. So we are done with the banking laws, guys. So in exam, if a question is asked, you should be able to answer any question from banking laws. Okay? Chalo, guys. Now what we'll do is we'll take a break of 5 minutes. We'll resume at 5:30 p.m. with the insurance laws. Very simple chapter, very small chapter. It will be done in 20-25 minutes maximum. Chalo, guys. Yes, guys. Chalo, guys. Let's begin with the last chapter, and then we are done with the 9 days marathon lectures. The next chapter is, guys, insurance laws. Insurance laws. So how many questions are we supposed to study, sir? 1. So 7 questions, guys. Once you are done with these 7 questions, you are sorted. Okay, very simple chapter compared to banking laws. Insurance laws is very simple. Okay, let's get started. Number 1, guys, briefly discuss the principles of indemnity and subrogation. Now, guys, what is the meaning of indemnity? Let's understand this first using example. If a factory insured for 10 lakh rupees suffers a loss of 6 lakh rupees, you tell me how much the insurance company will pay? 6 lakhs or 10 lakhs, guys? They will pay only 6 lakh rupees because this guy only suffered a loss of 6 lakh rupees. Now the important question is, what does this say? This says that indemnity means the insured is restored to the same financial position as he was before suffering the loss, not a better position. If you suffered a loss of 6 lakh rupees, you will only get 6 lakh rupees, not a penny more than that. Insurer agrees to compensate the insured for actual loss suffered due to the occurrence of the insured event. The loss must be proven by the insured. The loss must be proven by the insured. The indemnity is limited to the sum insured under the policy, obviously. So if you suffered a loss of 12 lakh rupees and your insured amount is 10 lakh rupees, you will only get 10 lakh rupees. Okay. Compensation is given only for the proximate cause of loss. Sir, what is the meaning of proximate cause of loss? You have taken fire insurance policy against your goods. So you will get compensation from the insurance company only if the goods are destroyed by fire. If the goods are destroyed, if the goods are stolen, you will not get any money from the insurance company. So you have taken money against fire insurance. You will get money only when your goods are destroyed by fire. This is called as proximate cause. If your goods are stolen, you will not get a money. Okay. The market value of the property is considered while calculating the indemnity. Okay. This 6 lakh loss will be calculated by a valuation. Then only insurance company will pay you 6 lakh rupees. Okay. This is called as principle of indemnity. Now, what is the meaning of principle of subrogation, sir? Simple, guys. Let's read the example. If goods are damaged due to transporter's negligence and the insurer pays the claim to the insured, the insurer can now sue the transporter to recover the amount. Simple. A, B, C. A is the insured, C is the insurer, transporter. Okay. So transporter's negligence, because of transporter's negligence, A suffered a loss of rupees 10 lakh rupees. Yes or no, guys? Now A has a right to sue B. Right to sue B, but he is not suing B. Why? Because insurer has already paid rupees 10 lakh. Easy, guys. If insurer has paid A 10 lakh rupees, A has suffered a loss, A is happy. Now we also have to make insurer happy. So what will insurer do? Now insurer will sue B and not A. There is no connection between insurer and the transporter, but there is a connection between the transporter and A. Now insurer is taking the place of A to file a case against B. Are you able to understand, guys? Can I get a quick thumbs up? So let's read this. After paying the claim, the insurer gets the right to step into the shoes of the insured. Insurer has the right to get into the shoes of Mr. A. The insurer can recover the loss from the third party responsible for the damage. This prevents the insured from receiving double compensation. So guys, tell me, is A filing a case against B? No. If A is also filing a case, insurer is also filing a case, not allowed. Only one person shall file a case. If A has filed a case against B and court has given A compensation of 10 lakh rupees, A has got no right to claim money from the insurance company. You can only claim amount once. Okay. So guys, this is called as principle of indemnity and principle of subrogation. The language is very easy, so you can read, understand and learn. I have included introduction, I have also included conclusion. So you should not have any problem. Okay guys, chalo. Question number 2. Outline the objectives behind setting up IRDA in India. Insurance Regulatory Development Authority. What exactly are the objectives we are going to understand? 1, 2, 3, 4, 5. 5 objectives are there, guys. Number 1 is protection of policy holders' interest. If insurance company is not paying the policy holder the money, which is very genuine, then IRDA will step in between. Example, if an insurer rejects a genuine health insurance claim without a reason, IRDAI can intervene and direct settlement. IRDA ensures that policy holders are treated in a fair manner. It monitors claim settlement, premium charges and policy conditions so that insurance company don't exploit the policy holders. Okay, next is guys, regulation of insurance industry. Who will regulate the insurance industry? IRDAI will regulate insurance industry. So IRDAI regulates the working of insurance companies. It ensures proper conduct and compliance with the rules. Before a new company like a startup insurer begins operation, it must get IRDA approval and license. Same like banking company. If you want to start insurance business, you have to take the approval of IRDAI. Okay, sir. Third is promotion and development of industry. Whose job is to promote and develop the insurance industry? IRDAI job is to promote and develop the insurance industry. So if they come across any new digital products so that insurance can be accessible by everyone, it's their job. Whose job? IRDAI job. So IRDA promotes growth and competition in the insurance sector. It encourages innovation and better services. Example guys, intro of new digital insurance products like app-based policies improves accessibility. Okay, 3 points done guys. Fourth point is ensuring orderly growth. What is the meaning of orderly growth? IRDAI prevents companies from offering misleading policies or unrealistic returns just to attract customers. If any insurance company is falsely misleading you to attract more money, IRDAI will step in between. Ensures that the industry grows in a stable and in a balanced manner. It avoids unhealthy competition and unfair practices. Next is matters connected or incidental. So any matter, similar matter will also be dealt by IRDAI. Simple guys. In exam, definitely question can be asked, what are the objectives behind setting up IRDA in India? Number 1 is guys, protection of policyholders' interest. Number 2 is regulation of insurance industry. Number 3 is promotion and development of industry. 4th is ensuring orderly growth. 5th is matters connected to therewith. That's it, guys. Very easy now. So guys, I can give you guarantee that in one day you can complete banking also, insurance also, FEMA also. So please guys, don't leave these chapters. Very, very important for exams. If any other chapter that you have that you think is important, if a difficult question has been asked from that chapter, guys, then these 3 chapters are your savior. Simple now, guys. Is it difficult? You can simply learn it. In one day you can finish it off. When you are done with 100% syllabus, guys, you just look at your marks in CMA Final Law. You are going to do wonders, provided you cover 100% of syllabus. You don't know which topic will be useful to you in life, in what way. Okay, chalo guys, this one is done. Next is third question. What are the restrictions on agency of insurance under the Insurance Act? So guys, we all know the insurance industry includes agents and insurers. So we need to regulate them. We know that we are supposed to regulate insurance company, but insurance agents also we have to regulate. Let's understand this, guys. 1, 2, 3, 4, 5, 6 points. 6 points are there, guys. Very, very easy. Number 1, restriction on commission. Only that agent who has got a license should receive a commission. If you are an insurance agent, I am your friend. If I have sold insurance policy on behalf of you and you are paying me commission money, it is completely prohibited, not allowed. Only those who have got license can only receive commission. Only licensed insurance agents or registered intermediaries can receive commission. No other person is allowed to receive remuneration for procuring insurance business. Number 1 is restriction on commission. Number 2 is, guys, appointment of agents, section 42. Let's understand them. Only persons with prescribed qualification and license can be appointed as agents. The agent must not be disqualified under IRDAI regulations. A person must pass IRDAI exam and training before becoming an insurance agent. 2 points, very easy, guys. Third is 1 insurer per category rule. Now this is very, very important. So an agent can only represent 1 life insurer, 1 general insurer, 1 health insurer. If you are an agent in multiple insurer, then you will act in a biased manner. That is not allowed. Only pick 1 insurer and you have to work under them. Okay? An agent cannot sell policies of LIC and another life insurance company together. Easy, guys. Chalo. Prohibition of multi-level marketing. We all have come across this kind of scam where you bring in 3 people, you will get money, and those 3 people will bring in another 3 people, they will get money. This is scam. It is not allowed in insurance agent. So if an insurance agent gives you money that you bring in 3 clients, I will give you money, it is called as, guys, multi-level marketing scheme. It is not allowed. An agent cannot create a chain where people earn by recruiting others to sell policies. You are an agent, you sell policy, then you will receive commission. You cannot pay money to some other person and you will do nothing. Okay, guys. Restriction on agents acting as directors. This is the best part. Insurance company directors cannot act as agents, or agents cannot become directors. An insurance agent cannot become a director of an insurance company without prior approval of IRDAI. Guys, tell me, if you are a director in an insurance company, you will think long term, you will not think short term. But if you are an agent of an insurance company, you will think short term. So how can one person do short term work also, long term work also without conflict of interest? Not possible. And that is why, guys, this rule has been made. An agent working for a company cannot directly join its board of directors without the approval of IRDAI. Next is guys, ban on principal, chief, special agents. Again, you cannot have a pyramid level of agents. Companies cannot appoint super agents who control other agents. There should only be one hierarchy, and all these ones shall be agents. You cannot have agents working under you, people working under them. Not allowed. So guys, tell me quickly, what are the rules for the insurance agents? Very, very important. In your exam, question will come. Number 1 is guys, restriction on commission. Number 2 is appointment of agents. Number 3, one insurer per category rule. Number 4, prohibition of MLM. Number 5, restriction of agents acting as directors. And number 6 is ban on principal, chief, special agents. That's it guys. Very easy now. Can I get a thumbs up? Now next is discuss the principle of insurance guys. Very, very important. Again, from the exam point of view, you have to learn it. If you observe guys, all the important questions, all questions are equally important. You have to study them thoroughly. Okay. Insurance contracts are governed under certain fundamental principles. What are those fundamental principles? Number 1, utmost good faith. If you are suffering a disease, if you are ill and you are not disclosing these details while taking a life insurance policy, then life insurance policy, life insurer can reject your claim. Whatever information you have got to share it, you have to share it. You cannot hide any information with the insurer company. Otherwise, they can cancel or reject your claim. Both the insurer as well as insured must disclose all material facts. Suppression or non-disclosure makes the policy completely voidable. Insurer as well as insured must disclose all the information honestly. If any one of them don't disclose, it will be voidable at the option of other party. Other party can cancel the contract. Okay. Number 2 is guys, principle of insurable interest. So if I am taking a car insurance, that car should belong to me. If I am taking fire insurance, that goods should belong to me. So I should have insurable interest. What is the meaning of insurable interest? If I lose those goods, I will suffer loss. No other person shall suffer loss. That is called as insurable interest. I told you guys, gambling, speculation is not allowed. Now, if I take insurance against your goods, if you lose your goods, I will earn money. Do I have any insurable interest in you? No. I have not suffered a loss, but I have earned profit from the insurance company. Then guys, don't you think everyone will start doing this and they will do gambling with this? If I take insurance policy of my neighbor's car, he does not even know, but I have taken car insurance of my neighbor. If that neighbor comes across with any accident, then I will get money. Guys, this is called as gambling, which is again not allowed. So I should have the insurable interest. No other person shall have insurable interest. Okay. The insured must have legal or financial interest in the subject matter. Without insurable interest, the contract becomes a wagering agreement and is void. Wagering means what? Betting, gambling is called as wagering agreement. A person can insure his own house, but he cannot insure a stranger's house. Very, very important. Next is, we know the meaning of principle of indemnity. Insurance provides compensation only for actual loss. The insured cannot make profit from insurance. Life insurance is not a contract of indemnity. So what is the meaning of? So why, guys, tell me why life insurance is not a contract of indemnity? Because when you lose a life, value cannot be ascertained. That is why life insurance policy is not a contract of indemnity. So 3 points, guys. Number 1 is insurance provides compensation only for actual loss. Number 2, the insured cannot make profit from insurance. Like I told you, if I take insurance from my neighbor's car, that means what? I am earning profit from my neighbor's insurance. Third is life insurance is not a contract of indemnity. Why? Because you cannot put a value to a life. Okay. Principle of subrogation, I told you guys, insurer will come in my position to file a case against the transporter. But transporter damages goods and the insurer pays a claim. Now the insurer will come in my place to recover the amount from the transporter. Very easy. After paying the claim, the insurer gets the right to recover from a third party who is responsible. Proximate cause, I told you guys, if I have taken fire insurance, my goods shall be destroyed by fire only. Then only I will receive money from the insurance company. Sixth is, guys, principle of contribution. If A, B, C, D, all these are insurance company, they have agreed to give me insurance. So if I suffer a loss, all these companies have to pay proportionately. Like we have understood in IBC, Committee of Creditors get voting rights as per the amount of debt owed by them. In the same way, principle of contribution works. So guys, 6 principles. If an exam question is asked, discuss the principles of insurance, you should be able to answer the question. Number 1 is principle of utmost good faith. Number 2 is principle of insurable interest. Number 3 is principle of indemnity. Number 4, principle of subrogation. And number 5, principle of proximate cause. And number 6 is principle of contribution. Easy now, guys. Jayanand, is my voice not audible? 1 second, wait.
Jayanand, is my voice not audible?
Okay, no problem, Jayanand, no problem. Okay, just watch my remaining lectures. We are done. 3 more questions and then we are done. Okay, chalo. Next question is, guys, explain the principle of insurable interest and when it must exist in different types of insurance. If I have taken insurance for a vehicle, I should suffer a loss. That is called as insurable interest. Okay. Some problem with my mobile. No problem, Jayanand. You can watch it after the live ends. So what is the meaning of insurable interest, sir? The insured must have a real and lawful interest in the subject matter. If I don't have any interest and I take insurance, it is not valid. The interest must be financial and measurable. I should suffer a loss if my goods are lost. I should suffer a loss if my goods are destroyed. Without insurable interest, the contract becomes a wagering agreement and is void. Now I told you what is the meaning of wagering agreement, guys. When you insure your neighbor's house, if it burns, you will receive money. Neighbor will not receive any money. Did you suffer a loss? No. So this is called as wagering agreement. You suffer no loss. This is called as wagering agreement. Now, the important question is, when should the insurable interest exist? Life insurance, fire, motor insurance, marine insurance. So in 3 cases, insurable interest must exist. In life insurance, guys, insurable interest must only exist at the time of taking the policy. If a wife has taken life insurance against the life of a husband, and if they end up getting a divorce, the husband is no longer the husband of that wife. Still, if anything happens to that husband, the wife will receive money. Why? Because law says that insurable interest must only exist at the time of taking the policy. Are you able to understand, guys? Every single term we are understanding using examples. Next is fire and motor insurance. Over here, guys, insurable interest must exist at the time of policy. and also as well as the time of loss. If motor or via fire insurance, you must be the owner of goods. While the goods are damaged, you should also be the owner of goods. If a person sells his car before accident, no claim allowed. You have taken car insurance and then you have sold your car. Then once that car comes across with an accident, you will not receive insurance money. Simple, guys. Next is marine insurance. Over here, guys, insurable interest must exist only at the time of loss. So if I am supposed to receive goods, these goods does not belong to me right now. It will belong to me once I receive the goods. So I can take insurance against these goods also, guys, if the goods are in transit. Buyer insures goods during transit. If the goods are during transit, the goods does not belong to me. I don't have insurable interest, but claim is valid only if he owns goods at the time of loss. At the time of loss, you should own goods, not at the time of taking the policy. But in case of fire and motor insurance, insurable interest must be present at the time of taking policy, at the time of loss. Over here, only at the time of taking policy, insurable interest must be present. So guys, if an exam question comes, you should be able to answer it. Okay. Next question, guys. Second question. Explain the sufficiency of assets under section 64 of the Insurance Act 1938. So what is the meaning of sufficiency of assets? Simple, guys. If your insurance company has got a lot of risk, you should have capital. Same like banking company, but this is for insurance company. Let's understand them. Provisions 1, 2, 3, 4. 4 provisions are there. Okay. Number 1, meaning of solvency requirement. What is the meaning of solvency requirement? An insurer must always maintain assets exceeding their liabilities, so that tomorrow during exceptional situations, bad situations, they should not run out of money. This ensures that the company can meet all the policy holders' claims. If an insurer has liability of 100 crores, it must maintain assets more than 100 crores. Very easy. Number 2, minimum solvency margin. What is a minimum margin? What is a minimum solvency margin? Let's first understand this using example. Minimum capital is, let's say, 100 crores. If you are in an insurance, sector, and IRDAI, as per your business, it requires you to have minimum 100 crores. You can have more than 100 crores, but minimum 100 crores capital you should have. Required solvency margin is 50 crores. Now, exactly what is the meaning of this? Let's understand. 50% is 50 crores. That means insurance company must have liabilities worth of money. That is different. Apart from liabilities worth of money, they should have additional 50 crores. So liability plus 50 crores they must have as assets. Now let's read this, guys. The insurer must maintain a minimum excess of assets over liability. The solvency margin must be at least 50% of the minimum capital requirement under section 6. The calculation is done as per IRDAI regulation. Simple. If insurance company requires you to have certain minimum capital, take 50% and just add it to the liabilities. That much amount of money you should have as assets. Simple. Step 1, find out minimum capital. Step 2, take 50%. Step 3, liabilities plus assets, liabilities plus 50% added. These are your asset requirement. These are your asset requirement. Okay. Chalo. Non-compliance. If the insurer fails to maintain solvency, it may be called as insolvent. The court may order winding up of the insurance company. Regulatory action by IRDA. IRDA may ask the insurance company that you need to now reduce your business operations because you're not maintaining solvency requirement. Number 2, insurance company can order financial restructuring, debt equity ratio, they will change the structure. Number 3 is cancel the license. So guys, how many points are there? 4 points. Number 1 is solvency requirement, meaning we understood what is the minimum solvency requirement, we understood. Third is non-compliance, and fourth is regulatory action by IRDAI. Last question of this marathon lecture. Explain the powers and duties of IRDAI. Number 1 is they have the power to grant license to insurance companies also, intermediaries also. Protection of policy holders, they will do the claim settlement, they will do surrender value. What is the meaning of surrender value? If I don't want to wait till my policy gets over, if I cancel my policy before its expiry, I am supposed to receive some money, that is called as surrender value. Third is insurable interest. All these aspects IRDA will check. Third is regulation of insurance industry. How? By training and giving qualification to agents and intermediaries, and code of conduct supposed to be followed. Financial control. IRDA monitors investments of insurers and also solvency margin. Inspection, investigation, conduct inspections and appoint auditors or actuaries. Okay. Now, dispute resolution. If there is any dispute between intermediaries, policy holders or insurers, IRDA Act will, sir, please provide daily material. Yes, Janand, once this marathon lecture ends, I will provide you daily material. So guys, any dispute that arises between insurers, intermediaries will be resolved by whom? IRDAI. So, how many points are there, guys? Licensing power, protection of policyholders, regulation of insurance industry, financial control, inspection and investigation, dispute resolution, and that's it. We are done with the insurance chapter. So guys, 100% of syllabus is done. Simply watch my marathon lectures, study my notes, and you'll be sorted. Nobody can stop you from scoring 70 plus marks in CMA Final Law if you have done all these things. Okay? Janand, if you want to say anything, let me know. We will end this lecture, guys. It was a wonderful experience teaching you for 9 days straight. Chalo guys, let's end this lecture. Thank you so much for watching, guys. Trust me, if you watch these 9 lectures, you're going to get wonderful marks in CMA Final Law. Any doubt if you have got, please make sure that you drop all your doubts in the YouTube comment section. Okay? And apart from that, if you have any other doubts, you can contact me on WhatsApp. You know my number. You will find it in the description. You will join that WhatsApp group. I am very much active in the WhatsApp, guys. So I'm always available for every single one of you. Okay? Chalo guys. Thank you so much. Eat well, sleep well, study well, and take care. All the very best for your exams, guys. Bye bye. Bye bye.